Harry, and today we are looking at a very important development in the precious metals market, where both gold and silver are moving higher. And on the surface, this might look like a simple bullish move, driven by typical factors. But as an independent analyst, I want to go deeper, because what we are seeing right now is not just price action. It is a combination of macro signals, liquidity shifts, and geopolitical influence that is shaping this move. And when we break it down from a professional standpoint, many large analysts are attributing this upward movement to easing geopolitical tensions, particularly around Iran, alongside reduced expectations of interest rate hikes by the Federal Reserve. And while that explanation is valid to an extent, I believe it is incomplete because it focuses too much on surface triggers rather than underlying structural dynamics. Now, if we analyze this relationship between the dollar and metals, traditionally a stronger dollar should pressure gold and silver lower, yet in this case both are rising simultaneously, which tells us something unusual is happening beneath the surface. And this is where I align partially with macro analysts, who suggest that safe haven demand is increasing, but I would extend that argument further by saying that this is not just about safety. It is about positioning ahead of uncertainty, because markets are forward-looking, and when participants anticipate instability, they begin reallocating capital into assets that preserve value regardless of currency strength. Now, when we look at silver outperforming gold, this is another critical signal, because historically silver tends to move more aggressively during bullish phases, due to its dual role as both a monetary and industrial metal, and the narrowing gold-silver ratio reflects that shift in momentum. However, I would caution that such rapid moves also increase volatility and risk of short-term corrections. So while the bullish narrative is strong, investors need to remain aware that markets rarely move in a straight line, and what we are witnessing could be the early stages of a broader trend rather than a completed move, which means patience and strategic positioning become far more important than chasing price action at elevated levels. As we continue this breakdown, the next layer to analyze is the role of monetary policy expectations, because one of the biggest drivers behind this move is the declining probability of interest rate hikes. And this is something that many top analysts have been closely watching, because interest rates, directly influence the opportunity cost of holding non-yielding assets like gold and silver. And when the market begins to price in a pause or slowdown in rate hikes, it creates a supportive environment for metals. Now, I agree with this framework, but I also think it needs to be viewed in context. Because even if rate hikes are paused, it does not automatically mean conditions become favorable across the board. What matters more is the direction of real rates, which factor in inflation. And if inflation remains persistent, while nominal rates stabilize or decline, then real returns on cash and securities. Bonds remain weak, which ultimately supports precious metals. And this is where I see alignment with traditional gold bulls. But I would add that today's environment is far more complex than previous cycles, because inflation is not solely driven by demand. It is heavily influenced by supply-side constraints, energy prices, and geopolitical disruptions, which makes it harder for central banks to control through conventional policy tools. And this creates a situation where even if the Fed holds rates steady, the underlying pressures do not disappear. They simply shift form and continue to influence asset prices. Now, when we connect this to silver's historic run of consecutive monthly gains, it becomes clear that momentum has been building for quite some time. And while some analysts see the potential end of this streak as a sign, as a commodity, I view it differently, because markets need consolidation phases to sustain long-term trends, and if silver establishes a stable base at higher levels, it actually strengthens the overall bullish structure, rather than weakening it. So, again, the key takeaway here is that short-term fluctuations should not distract from the broader trajectory, which remains influenced by macroeconomic conditions that continue to favor hard assets over fiat-based instruments. Now, shifting focus to global market dynamics. One of the most important signals that often gets overlooked by retail investors is the pricing difference between Eastern and Western markets, particularly the premium seen in Shanghai, compared to COMEX, and this premium indicates strong physical demand in Asia, which is a critical factor, Because while paper markets can influence short-term prices, physical demand ultimately anchors long-term value, and many experienced analysts point to these premiums as evidence of tightening supply conditions and growing investor interest outside the Western financialized system. And I strongly agree with this perspective, but I would also emphasize that this divergence between paper and physical markets highlights a deeper issue, which is the increasing disconnect between financial derivatives and tangible assets. And this is where the concept of counterparty risk in yen becomes extremely important, because as highlighted in the script, physical gold and silver held directly by investors carry no counterparty risk, meaning their value does not depend on the performance or solvency of another entity. And this stands in stark contrast to assets like stocks, bonds, or even digital currencies, which rely on systems infrastructure and institutional stability to maintain their value. Now, from my independent viewpoint, this distinction is becoming more relevant as global uncertainty increases, because trust in financial systems is not constant. It fluctuates based on economic and political conditions. And when that trust begins to weaken, investors naturally gravitate toward assets that exist outside those systems. And this is why, despite periods of volatility, precious metals continue to attract long-term interest, because they offer a level of security that cannot be replicated by purely digital or paper-based assets. And this fundamental difference is something that investors need to fully understand, rather than simply reacting to short-term price movements. Another very important aspect raised in this discussion is the issue of authenticity and trust within the Nyambuyan physical metals market, particularly highlighted by the incident involving Era Britannia coins that contained no silver. And while this was described as a small and isolated production mistake by the Royal Mint, it raises a broader question about verification and due diligence, and many analysts downplay such incidents as rare anomalies, which is technically true. But from a risk management perspective, even rare events deserve attention, because they reveal potential vulnerabilities in systems that are otherwise assumed to be reliable. Now, from my perspective, this is not about creating fear, but about reinforcing the principle of trust but verify, because in any market where physical assets are involved, authenticity becomes a critical factor. And while reputable mints and dealers maintain high standards, mistakes can still occur. And this is where working with trusted sources and having basic verification methods becomes essential. Now, interestingly, some analysts have pointed out that such error coins could actually become valuable collectors due to their rarity, which adds an entirely different dimension to the discussion, because it shows how market perception can transform a flaw into a feature. And while I agree with that possibility, I would caution against relying on such outcomes as part of an investment strategy, because they are unpredictable and driven more by collector sentiment than intrinsic value. So the real takeaway here is not about chasing rare errors, but about chasing rare errors, but about understanding the importance of authenticity in preserving the integrity of your holdings and ensuring that your exposure to precious metals is based on genuine assets rather than assumptions. Another very important aspect raised in this discussion is the issue of authenticity and trust within the physical metals market, particularly highlighted by the incident involving Error Britannia coins that contained no silver. And while this was described as a small and isolated production mistake by the Royal Mint, it raises a broader question about verification and due diligence, and many analysts downplay such incidents as rare anomalies, which is technically true. But from a risk management perspective, even rare events deserve attention, because they reveal potential vulnerabilities in systems that are otherwise assumed to be reliable. Now, from my perspective, this is not about creating fear, but about reinforcing the principle of trust, but verify, because in any market where physical assets are involved, authenticity becomes a critical factor. And while reputable mints and dealers maintain high standards, mistakes can still occur. And this is where working with trusted sources and having basic verification methods becomes essential. Now, interestingly, some analysts have pointed out that such error coins could actually become valuable collector items due to their rarity, which adds an entirely different dimension to the discussion, because it shows how market perception can transform a flaw into a feature. And while I agree with that possibility, I would caution against relying on such outcomes as part of an investment strategy, because they are unpredictable and driven more by collector sentiment than intrinsic value. So the real takeaway here is not about chasing rare errors, but about understanding the importance of authenticity in preserving the integrity of your holdings and ensuring that your exposure to precious metals is based on genuine assets rather than the assumptions. As we bring this entire analysis together, the most important conclusion is that the current movement in gold and silver is not being driven by a single factor, but by a convergence of multiple forces, including shifting monetary policy expectations, geopolitical developments, physical demand, dynamics, and underlying concerns about financial system stability. And while many analysts focus on individual drivers, I believe the real insight comes from understanding how these factors interact with each other, because markets are complex systems where no single variable operates in isolation. And this is why simplistic explanations often fail to capture the full picture. Now, from my independent standpoint, the broader trend remains constructive for precious metals, but the path forward is unlikely to be smooth because periods of rapid gains are often followed by consolidation or correction phases, and this is a natural part of any sustainable bull market, and investors who recognize this dynamic are better positioned to navigate volatility without losing sight of long-term objectives. And ultimately, the key question is not whether gold and silver will continue to experience short-term fluctuations, but whether the underlying conditions that support their value are strengthening or weakening. And based on current data, those conditions appear to be strengthening, which suggests that despite temporary setbacks, the long-term outlook remains positive. However, success in this environment requires discipline, patience, and a clear understanding of market structure rather than emotional reactions to daily price movements. This is Prof. Eri, and you're watching Metal Market News, where we go beyond the headlines to deliver real independent analysis that helps you understand not just what is happening, but why it matters.